Good afternoon, everyone, and welcome to our webinar today on protecting your business succession. We're delighted to hold this webinar with our Society's legal partner, A&L Goodbody. Business succession planning is a critical topic, particularly with so many changes taking place. So whether you're a business owner or an advisor, having a clear strategy in place is critical to ensure long-term stability and growth. We ran an in-person series on this topic across Northern Ireland in 2023-24, and feedback from that series was really positive. So we feel that now is a good time to revisit this topic for an update. Today, we're going to explore key succession planning strategies, discuss the latest trends, and address some of the new challenges that family-owned businesses face, especially in light of recent changes in the UK budget statement. We're fortunate to have two leading experts here with us today. Firstly, we have Mark Thompson from A&L Goodbody, who will provide insights into the legal aspects of succession planning. Mark is a partner in A&L Goodbody's corporate and M&A practice in Belfast. His corporate practice focuses on corporate finance, mergers and acquisitions, management buyouts, reorganisation and strategic advice. And he also leads the commercial team and has extensive experience on advising in commercial contracts and trading arrangements. We're then going to hear from Gemma Johnson, who's a director at Grant Thornton, and Gemma is going to delve into the financial and tax considerations critical to a successful transition. Gemma has over 20 years experience working in practice with a focus on advising high net worth individuals and private business owners on all aspects of personal tax. Gemma specialises in structuring and planning for privately held business interests, designing bespoke tax-efficient solutions for shareholders, whether they're planning for a sale, focused growth, or considering succession. So today, we're going to look at best practices in business succession planning, legal and tax implications for business owners, and practical guidance on advising clients through this complex process. As always on these webinars, we are keen to have your input, so please pop your questions into the Q&A box at the bottom of your screen, and we'll pick them up after the presentations. So with that, I'll ask Mark to kick us off. Thank you.
Thanks very much, Gillian, and good afternoon, everyone. Whilst I'm talking, we'll be looking more at the commercial and legal implications for succession planning and the impact last year's budgets had on it. And then I'll be passing the more challenging task over to Gemma Johnson from Grant Thornton, who'll be looking at what that's done to the tax planning environment. So, Gary, if you can maybe give us the next slide, please. So I've kept this lovely graphic from the last series that Gillian just referenced because I thought it was still applicable. Succession is complex, and it's a very difficult process, which takes time to get right. The statistics suggest that only 12% of family-owned businesses actually manage to make it through to the third generation. So it's important for families to get that right, whether they're farming or general business families. The environment was increased significantly, I think. Summer 24 planning was a lot easier, I think. The budget has raised a lot of challenges now, which we'll come on to. But the issues and needs of the business and those of the owners remain the same, and they frequently come into conflict. This is particularly the case where you see ownership, management, and ultimately equity participation in the business fragment and go on to the next generation. And the new tax environment and the funding liabilities for tax that are in play now are really making that much more complex than it used to be. So what are we talking about? Next slide, please. I'm going to give you a little BPR and APR refresher. That's a lawyer's review, so it won't be too complex, but I think it's always good to set the scene. Then I'm going to just summarise what I see as the 30th of October budget changes. Then I'll run through some legal and commercial impacts, what I think those have in terms of implications for your planning process, and then a little touch on what impact that has on Northern Ireland specifically. On the next slide, I thought it was worth looking at some of the media reaction that we had after the budget. when I was going back, I thought this would be colourful because there was a bit of uproar. There was a lot of noise in the press, you remember. But when you look at it, 75% plus was actually all around the agricultural property relief. So plaudits to the NFU, an advertisement for being a unionised industry. Very little at the time by comparison from regular non-agricultural businesses. And I'm not sure how much that has changed to date. In terms of what's driving the change in the next slide, then a little bit of policy. I think it's clearly a governmental change. You can read those yourselves. Those are statements from the HMRC and our Prime Minister. HMRC has said that they're targeting the top 7% of APR claims, which is about 117 claims per annum, which are taking up 40% of the relief claim value in aggregate, about 220 million. That equates to about 27% of all APR claims being taken from that top 7%. I don't think it's for us to consider whether that's that 30% of the states is that a very small number, but the line from government has been it's not fair for a very small number of claimants each year to claim such significant amounts of money that could be better used to fund public services. So a very strong political theme there. Don't know how long that policy will remain or that approach, but only time will tell. And I think, again, if you look at the stats that are available, they're talking about 30% of agricultural claims. No data that I could find around business property relief claims, which I think could be a much broader impact. On the next slide, then, just understanding of BPR, pretty quick, simple refresher. BPR is our tax relief on business assets to support business continuity. Agricultural property relief is the same in principle, but it's more about family succession and keeping the farm functional. And historically, that provided up to 100% relief from inheritance tax. To quote our friends, the meerkats, it was simple. Estate planning with a family business was pretty straightforward, but the budget has impacted that to a really serious degree now. If we look to the next slide, then, again, I think you'll be familiar with these. This kind of kicks in 12 months. BPR and APR combined have a cap of £1 million in the relief. So in the past, where your business or agricultural assets were completely exempt, it's now capped at 1 million, and anything in excess is hit at 20%. So what does that look like in practice? Eligibility is likely to be more stringent. We're likely to see an increase in lifetime transfers, but as Gemma will flag, changes to capital gains regime made at the same time has made that more tricky too. And in the past, we wouldn't have a need for valuations really. It was all relieved, so not an issue. But if you're gifting qualifying assets now, or you're valuing on death, there is potential for argument there. So that's something we can come on to. And I thought the best way of putting this in context was to come up with a couple of scenarios. Now, apologies, if we go to the next slide, please. I am a lawyer. The numbers may not be completely accurate, but I have borrowed them from various sources. In scenario one, family-owned construction company, a land bank of 9 million, value that's not going to really shift. Working capital of about 1 million in the business. Total value, let's call it 10. Tax and death, 1.8 million. Expectations for the family were full business property relief, and now they will have to work out how they're going to fund that tax bill. If we move to the second scenario, a family farm, let's call it 70 acres, land, machinery, livestock coming in at about 2.4, house and assets 500,000, total estate just under 3. After APR allowance of 1 million and nil rate band allowances, taxable estate comes in at 1.65 million. So that's a tax bill of 250,000. Again, expectations of the family, full relief. So they're going to have to come up with £250,000 from a business which is probably tight enough to fund that tax. And again, there will be valuation arguments, discrepancies around what the asset is actually worth. The third scenario, then, I just thought make the numbers a little bit more interesting. Mid-Ulster family manufacturing company, profiting about 6 million a year, very entrepreneurial, working capital of 3 million in the business. Say the valuation's kicking around 60 million. They've been making acquisitions over the last three to 5 years, 300 staff, significant growth over the last decade. On that, you're looking at tax potentially 12 million at time of death. If the principal dies, however, that could seriously affect the value of the business. And, it's not unusual to see a fire sale whenever an entrepreneurial owner passes. And if that cuts the value in half, whilst it does reduce the inheritance tax, after tax, you could maybe find the family netting to 25 million of an asset that is actually worth 60. So again, they have to find the cash to fund the tax. So it's really much more challenging now post-budget. And there's a big cash flow hit for all businesses, not just the farmers, and it becomes painful pretty quickly. So if we go on to the next slide, then let's look at some of the commercial impacts. These are the key messages really for clients when you're having these conversations. The increased tax burden on family businesses and farmers is quite notable. And that has an impact on both business continuity for the family, but also the community. A lot of our businesses obviously are out of Belfast. That will pass on cash flow concerns potentially for the next generation. And again, I've referenced the valuation challenges already. We're looking at a couple of cases at the moment which we haven't really bottomed out, but you'll be familiar possibly with the sort of provisions you have certainly in businesses where there's multiple shareholders. There might be a valuation provision in the articles, which will sort of prorate value across all the participants in the business. Are those still a good thing? Does that impact valuation? How does that work with IHT? And those are proving to be quite tricky conversations. So that's just even part of the planning, raises challenging conversations. I think there's an active reassessment of trusts and estate planning structures now required. People have been doing that already since the budget came in, but with the clock ticking to next April, it really has got a high priority now. And I think with ongoing consultations, particularly around trusts and pensions, and legislation expected to come in due course, it's actually still quite an uncertain environment. So what about some legal impacts? So I think it's pretty fair to say existing succession plans are no longer fit for purpose. That sounds very bold, but it's gone from a zero tax to quite a chunky tax depending on the value of your business. And that necessarily means it's going to take longer to achieve an optimal position. You've also got to reconsider what assets will be chargeable. There's not just changes to the rate on business and agricultural property, but investment activity has also investment types like the AIM shareholdings have also had a different treatment imposed. So there is consideration to be given to passing on assets earlier, and with that goes the usual sort of legal work around updating wills and other aspects. However, a key part of that work we do in the sort of succession area is the governance piece. It's quite a challenging set of conversations around passing the business on to the next generation. Mum and dad sometimes find it difficult to let go. And again, there are implications there with gift with reservation potentially kicking in and protecting the business, making sure the right people are running it. Greater anti-avoidance scrutiny is expected. Obviously, there are new rules. There's an expectation that there'll be a good tax take on this set of changes. So anything you're planning around this, it's really critical to paper the work, whether that's around asset transfers, rationalizations, valuations. You want to have all your paperwork in order. So I think from a legal perspective, to minimize disputes or litigation around inheritance tax and so forth, it's important to paper it. And again, if it weren't enough for the families to have a larger IHT bill facing them, the costs, as we'll come on to, of professional advice is going to, increase, particularly as it's a preemptive kind of requirement now, given the change. So if we look at some succession planning thoughts, acceleration of ownership and operations, restructuring to protect the business owners. It's always important to remember in succession, that the business has been good to the family generally. It's been successful. They've had a good life. Uh, Tax is really important. The tax has to be managed. However, as part of these plans, when you're accelerating succession, acceleration of ownership to the next generation, it's important to make sure that the business is properly protected as well. If there is going to be a tax charge, there's planning required around the funding of that. Yes, there's a 10-year payment plan available, which Gemma will come on to, but there are other opportunities. What does it look like then? It's critically important to make sure allowances are used. I think the busy business people could quite often be too tied up in the business to actually look at that. So it's important to make sure all the allowances are maximised. Spouse and civil partnerships, who says romance is dead? Uh, Most efficient tax planning tool for older people who are single is they remarry, they can pass on assets to their spouse as always. Pets are important, but I think with the timing of the changes, some of your older clients, it's pretty tricky that these changes are so fundamental and they may not have the opportunity to put fully successful pets in place in due course. Therefore, life insurance is a really critical consideration. Put in trust for the next generation and quantifying exactly what the exposure is really, really important. That diversification of investment activities was just a reference to the AIM shares suffering a tax charge now as well. They were a very safe investment in terms of tax treatment historically, but now the changes there may mean that certain clients have to look elsewhere for the right investment destinations. If we go to the next slide now, Gary. Pensions is one of those destinations, much more important tool, perhaps than it has been in the past in terms of mitigation. Similarly, trusts are also likely to be used much more increasingly. However, as referenced above, there's still uncertainty around what exactly that's going to end up looking like because there's still consultations going on around that. So there's a high degree of uncertainty in the market at the minute about what actually you can and cannot do with your pensions and your trusts. And that all sounds very complex. Well, it is. This complexity really requires a holistic, wider approach and a wider team that'll cover accountancy, tax, pensions, trusts, and legal. Each piece pretty complicated now. So to the extent you need to bring in people to the team that aren't maybe necessarily running the relationship day to day, it's pretty important that if you're not a pension specialist, to pick somebody up with that expertise to help you. And again, I think to have these conversations and to get this process running, it's important for, again, I think it'll be you guys, the trusted advisors, and these were key relationships to start the ball rolling as quickly as you can. On the next slide then, some more commercial thoughts rather than tax and legal. It's always important to ask, will the business still meet the family's needs? That's the core strategic question underlying all this planning. If there's someone to take the business forward, to see it grow and continue to look after the family, great. But if not, then you're looking maybe at increased divestment occurring in the market, whether that's through trade sales, management buyouts, private equity investment, which we've seen so much of in Northern Ireland recently, or employee ownership trusts, which I think Gemma's going to cover those off. I think the employee ownership trusts are getting a lot of interest now because of the IHT change, which is great. And the IHT treatment there is a massive incentive. However, value can be a little bit lower. Payment maybe over a period of time that would be longer than if you're going for a trade sale or a private equity investment. And there remains a bit of a risk that you're divesting your asset without getting your value out up front. But it is, designed to assist with the IHT piece. And I think for some of our rural centres where there's maybe not a natural buyer for a business, it's certainly a very good opportunity. I think, as I've referenced above, we have to be going into this thinking there's potential for increased investigations, disputes, and litigation. So again, it's important to get the planning right. It's important to get it started early, and it's just key to kind of having an early conversation with those top 4 or 5 businesses you look after where the principals are getting to that certain age where they need, if they're knocking on 50, they need to be thinking about what happens next. because there's that obvious impact on life after retirement, both from a personal and a financial perspective. They need to be well, but they need to be able to live to the standard they've been hoping to. And those really personal and sensitive topics can drive the planning as much as the tax or the commercial or the legal. And again, it's very difficult to have those conversations with the whole family sometimes. So it's important just again to move into it easily with the key relationship that you have with the business to start having that conversation. And if we think about implications for Northern Ireland then for a minute, I mean, yes, this is legislation that's effective across the UK. However, if we go just to the next slide, please. In most regions of GB and Scotland, around each big city, there'll be a cluster of PLCs, larger businesses, and the infrastructure around those that gives the local economy a high level of solidity, where you can maybe withstand a tax impact like this. However, given the high reliance on agriculture in Northern Ireland and the high level of family businesses, due to the lack of PLCs, it's SME and farming community. This has a heavier impact, I would suggest, than other parts of the UK. We need to be mindful that increased tax burden may force sales that otherwise wouldn't happen. And if we want to mitigate that as a community, we need to plan for it and make sure that the tax itself isn't going to be the thing that's having an impact on those rural economies. Those implications are fundamental. I think there's a risk that if farms are going to people who can afford them rather than run them, that would not be great, and it could make our agricultural industry less competitive. And I've just put down cross-border tax planning complexities. We've always been spending plenty of time since Brexit working out exactly what that looks like, and there's depends which day of the week you read the article. There's a lot of commentary at the minute about now with our position and US tariffs and how that's actually going to work. So if you're working with clients that have got cross-border interests and the owners are of a certain age, again, I think it's really critical to start those conversations early. On the next slide now, again, this is one of, apologies to those of you who were saw the series last time. I've retained this slide again as what we really think the business review should look like. Strategic review is the first starting point. That's an easy conversation with your client. You're taking them through, where's the business at? What's its industry like? Is it a growth sector? Is it in a shrinking business? Is there consolidation at play at the minute? We see a lot of IFAs, for example, being bought out. There was a period there where a lot of dentist businesses were being bought out by GB operators. So there's a strategic analysis of what's the business like. Is it going to be sustainable going forward for the family or not? Financial review, don't need to tell accountants about that. It's just making sure that the health checks there, ensuring that contracts are in good shape. So where you have that entrepreneurial example I gave you, where the value of the business is impacted by the death of the principal. Those businesses, as we all know, are dependent on that key relationship. If you're concerned about that, the client needs to be thinking about contracting with the key customers, getting things on a longer term basis, having a team around the principal that will sustain the business and protect value for the family after a death. The taxation piece, obviously, is critical. And again, Jim will talk to that. Structure there is about what does it look like? Is that an exit? Or if it's a retained family succession plan, how does the governance look? Do you need a family charter? There's a whole series of conversations there to see what can you do to make sure the family continue to benefit from the business, because perhaps not all the children are able to work in the business. If you've got 2 or 3 families working in a larger business, again, there can be quite a bit of tension there when you're having those conversations. Very difficult for them to have them in person, but as the trusted business advisor, there's the opportunity for you to start the conversation, listen to all the stakeholders in the business and come back with recommendation about what works. I think personnel is the key point there. The business will not continue to flourish and provide for the family or families as it has in the past if it hasn't got the right people. So again, if there's a gap there, if they need an FD or an MD to come in who's non-family, so be it. But you need to start that process well in advance so that it's prepared and bedded down before the principals step down and retire. And again, estate planning is just taking the business piece and looking at it in context with all other assets that the individuals have. So quite a lot in that to unpack. It's not a 2-day job, it's not a 2-month job. When we did the last series, we started off saying maybe 2 or 3 years from start to finish. Again, it's a big project to get it right, and again with the legislation clock ticking, it's important to try to get these conversations rolling with your clients as promptly as you can. With that kind of review in front of you, I think I would encourage you to take 3 lenses to the process. The first lens is the business lens. And when you're looking through that lens, you're just checking the commercial viability. What are the financial aspirations of the principals? Is the business capable of sustaining those? You don't want to imprison the children in the next generation to working in a business to provide for the retirement of the founders. If it doesn't work, an exit may be the way to go. For the family, then, it's about equity and affordability. In those family situations where, say, 2 of the kids are working in the business and 2 or 3 of them aren't, quite often the surplus cash that the family had amassed over time was what was gifted to the children who didn't work in the business. If that's now being spent on IHT, what does it look like? Does it still continue to work? How do you involve the non-working children in the business going forward? So that's the family view. And then the final one is the individual. It has to work for the principals, because at the end of the day, they'll be surrendering a lot of control and influence and security on the back of what is ultimately a tax plan, but they're doing so in the best interest of their family. So just to finish off with some conclusions then, I think it's fairly evident the reviews need to be done as quickly as possible. There's a 12-month window here to try to take advantage of some opportunities that I'm sure Gemma will talk about. Care needs to be taken. There remains uncertainty. Consultations are ongoing. There's no guarantees that the next budget might come back and make further changes. We've always required and advised tailored strategies in these situations, but they're more complex now, and the first few planning examples that are tested are likely to be, or that are tested, are likely to get very close scrutiny, so it's important to get it right. So having those hard family conversations about tax, about succession, about commercial implications of the business really need to be happening now. And there are personal and commercial discussions which are very uncomfortable at times, but they're really critical to protect the family and their business. And again, individuals like yourself are very well placed to start those conversations. I started at the beginning by saying it was very surprising how little press there was around the impact of the changes on non-agricultural businesses. I think it's really critical that we start socializing the scope more and more. That's part of the rationale for the series. But in any conversations we're having with clients going forward now, again, if they're at that age and stage, we need to be socializing the impact of this and getting them started to think about what they need to be doing with their assets. So that's me for now. And I'm now going to pass you over to Gemma, who will get into the nuts and bolts of the tax tools that are being looked at now for dealing with the changes that came through in the budget. Over to you, Gemma.
Thanks, Mark. So as previously introduced, my name is Gemma Johnson, and I'm a director in the private client tax team at Grant Thornton. I'm going to be talking to you today about how the change in tax landscape is impacting our local family businesses, and going to discuss some options for potentially mitigating those changes. So in terms of what we're seeing, what has actually changed in the world of business succession? So back whenever things were straightforward, as Mark described it as simples, we had business property relief at 100%, and it had been that way since 1996. So this is a huge change for people. We had a capital gains tax-free uplift to market value and death, which we do still have. We have valuations on transfer of business assets, which were not overly important at the time. So any valuations we were putting on IHT forms, for example, didn't really matter that much, where we had 100% business property relief. If we fast forward to the autumn budget 6 months ago, we had a general increase in CGT rates, which will have an impact on our family businesses here. And we had the business property relief and agricultural property relief restriction. So we now have a restriction to 100% on the first £1 million of value, and then 50% on any value thereafter. And that will be effective from April 26. Some of the changes really were effective immediately because the government brought in anti-forestalling rules. So that really means that where we have, like, for example, we make a gift during lifetime, or say a gift into trust, for example, before April 26, and we have a death after April 26, the new rules will take effect and will apply to that lifetime gift. The changes to business property relief and agricultural property relief are due to take effect from April 26, as mentioned. But one thing we really should be aware of is that we will have another budget between now and then. So we will have another autumn statement in October. And I suppose our concern is that we don't know what that will bring and that some other further changes could be made. So really what we're saying is that there might be this window of opportunity at the moment. If whereby people want to undertake planning, we should really consider doing it pre-budget, given that we don't know what might happen after. We do still have the CGT free uplift on death, and that was one of the measures that we looked into before the budget, and we maybe had concerns that that might be removed. We do still have that, but now that means we have a trade-off between obtaining the capital gains tax-free uplift on death and doing IHT mitigation during lifetime. So it's really going to be important going forward to understand what the plans are for the business in the future. Like, for example, if there was a planned sale in the future, might it be better to access the capital gains tax-free uplift? So really considering those two taxes and trying to understand, what the taxes would be in both scenarios is going to be really important. And then, as mentioned, valuations are going to be much more important, and we are going to expect more HMRC inquiries. So where we're putting a value on an IHT form, a value of a business, and we're claiming business property relief, the revenue are going to be much more concerned about the fact now that they can now raise revenue from it. So we expect shares and assets valuation team at revenue to be much busier going into the future. So what does it mean for business owners? Business assets are now exposed to an effective rate of inheritance tax at 20% on any value above £1 million. And we know for a lot of our businesses in Northern Ireland, £1 million limit is not huge. So while 20% liability will really be a liability of the estate, it's effectively a personal liability. It's more than likely that the funds to pay that IHT liability will have to come from the business. And if a dividend is required to pay that IHT charge, that's going to be really costly because dividends are taxed to get them out of the business at a rate of almost 40%. So a rate of almost 40% to pay an IHT charge of 20% on the overall value could be extremely costly for the business. So business owners and FDs of family businesses are going to be, having to exercise caution and consider what those payments are likely to be going into the future. So we would be recommending the business owners and FDs need to really take steps to quantify any IHT exposure, especially that the business is going to have to pay. And holding on to business assets to death now is much riskier strategy. So in the past, obviously, it was much more simple. We just held on to business assets until death, got the CGT free uplift, IHT free. And now we really have to consider what it means to hold on to assets until death. And each person's situation is obviously going to be very unique. So taking into consideration what the family circumstances are and what each individual's personal wishes are is going to be really important. So what steps can business owners take to look at mitigating some of the IHT charges that will come with these new rules? This situation really is really a structure that we would look at for business owners, regardless of the fact that we've got these new changes coming in. And really all that it does is it takes what they currently have, doesn't look at, this doesn't involve any gifting away or any sort of depreciation in the value of someone's estate. All it does is it takes the value they currently have and it restructures it in a way that means that they can benefit from maximum business property relief. So typically we would see, if you look at the circumstance on the left here, say a married couple who have a trading company worth, say, value of £5 million, and they also have a property company with a value of, say, £3 million. Typically, wills at the moment are all structured to leave assets, all assets to surviving spouse on death, and we see that frequently. The IHT exposure on the second death here is actually going to be about £2 million, and that's because this is under the new rules, and that's because the trading company value will benefit from £1 million limit at 100% relief, and then the value above that will be subject to 20% tax, and then the property company will be subject to 40% IHT. If we restructure that business in such a way, whereas we introduce a holding company structure, which will hold the property and which will also hold the shares in the trading company, we can potentially get business property relief on the whole value. So, and if we restructure the wills in such a way, and this obviously it will involve Mark and the lawyers, restructure the wills in order to benefit from the £1 million business property relief allowance on the first death and the second death, then we can reduce the IHT exposure there to £1.2 million. And really that's just taking what we currently have and restructuring it just to maximise business property relief. We're not doing anything to depreciate the value of anyone's estate here. So that's something we would do quite frequently. Another option, as Mark had mentioned as well, lifetime gifting. I think we're going to see much more fragmentation of family businesses going into the future, whereby we'll have sort of the main shareholders gifting shares earlier during lifetime to the next generation. So where we gift early and survive the 7-year period, the gift is outside of the estate for inheritance tax purposes. On that gift during lifetime, it should be possible that gift relief should be available, and no capital gains tax may be due. That's just something you would have to analyse at the time of making the gift, just to make sure that that's free from capital gains tax. The lifetime gifts can be insured, so financial advisors can come into this conversation, and we can consider whether insurance is appropriate to insure the gift, and that can be taken out over the 7-year period, or it can step down as the 7-year period runs on. Minority interest discounts are obviously applied, and I think that's where we're going to see we could see a fragmentation of businesses going into the future, whereby people start to make use of the fact that minority interest discounts will apply. We can also look at capping the current value. So like the main shareholders, for example, could cap the current value of their shares and use growth shares to make sure that any growth in the future growth will happen in the shares which are maybe given to family members. We did have, as I mentioned, anti-forestalling rules, which mean that the new £1 million lifetime allowance will apply on death where gifts have been made from the date of the budget 6 months ago. So that's where you have a death after April 26, and gifts have been made since budget date. That the new £1 million lifetime allowance, and effectively the new rules, will apply to that gift, which will fall back into the estate. Where we do lifetime gifting, as I mentioned before, we lose the CGT-free uplift on death. So that's really important to ensure that we're considering the fact that we're losing that versus the fact that we're mitigating inheritance tax. And then obviously we lose the income that's attached to the asset. So when we gift away shares, then we lose the ability to receive dividends on those shares as well. So again, just going to be looking at everyone's individual circumstances and understanding sort of what their wants and needs are for the going into the future, and making sure that we're doing something that's appropriate. Planning how the IHT liability is going to be funded is going to be really, really important. And this is where we're getting into talks, with like FDs. They're really concerned about the fact that, the business might have to fund any liability. So what we could look at is, does the estate or the other the individuals, will there have to be a sale of other assets which are held? Will they have to consider taking out debt? So will bank lending need to be taken out? And that's something we're talking to the banks about at the moment as well. There is the ability to pay in installments, and that can be paid subject to conditions being met over a 10-year period, interest-free. So we could use that 10-year period effectively as a payment plan to get the IHT liability paid. Has life insurance been taken out? If they have life insurance, will that cover it? And should the family shareholders consider taking out life insurance now to make sure that that accounts for any IHT that has to be paid down the line? And as mentioned, dividends are going to be very expensive where the company has to fund them. The IHT liability, because dividends are taxed at a rate of almost 40%. And then to pay the IHT liability, it's a really expensive way for the payment to have to be made. A company purchase of own shares is probably the most tax efficient way of funding an IHT liability, because a company purchase of own shares can be used and can get capital treatment where it's where the funds are being used to pay an IHT liability, but there are certain conditions that need to be met. So company law conditions and tax conditions. So for example, the company has to have sufficient reserves, has to have sufficient cash available, and the IHT liability has to be paid within a 2-year period. There's also the undue hardship rule, which could be quite harsh. Like clearance can be sought on it, but I think if we're going to be going for clearance on it, it could be a difficult enough conversation to have with the revenue. And that undue hardship rule is such that it must not have been possible for the IHT liability to have been paid otherwise than via the company purchase of own shares. So we're thinking, does that mean that the revenue will look at other assets that the estate has to consider, well, could they have been sold to fund the IHT liability instead? Or perhaps look at other assets that the recipient of the gift would have. So there's just a few conditions need to be met there, but company purchase of own shares, given the fact that you can get a capital gains tax-free uplift on death, then the company's buying back those shares, it could be really tax efficient, and we might only have a stamp duty liability, in terms of tax exposure. And then trusts are becoming a much more talked about tool for managing IHT exposure. So trusts tend to come in and out of fashion a little bit, and we're finding that trusts are much more in fashion at the moment than what they used to be. Where we're transferring shares into trust, if we gift early enough and survive the 7-year period, that will be outside of the estate for inheritance tax purposes. We can get gift relief. We can get gift relief on the way in, so there's no capital gains tax payable. And the trusts allow us effectively to plan for inheritance tax charges every 10 years rather than having an unanticipated death and then an unexpected IHT charge up front. So really, the trusts are being used to plan out the IHT liability over a 10-year period. And it means that we know in 10 years' time we're going to have that liability as opposed to on an unexpected death. So people are finding that, and we find that clients tend to be quite receptive to that idea, that whereby we can transfer assets into trust now and then look to a 10-year period, and plan for that every 10 years. Where we do a gift into trust before April 26, so before the new rules really kick in, we can still get 100% business property relief on the way in. So there's no entry charge on the way in. However, if we leave a gift into trust until after April 26, that BPR rate then reduces to 50%, which means that there will be an entry charge if you're trying to get business assets into trust after April 26. However, as I mentioned before, we do have a budget coming up again in the autumn, and our thoughts are that if anybody's considering transfers into trust, that it would be sensible to really think about doing that before the next budget, just in case there could be further changes announced. Obviously, it's another lifetime gift, so you lose your capital gains tax-free uplift on death. So understanding what the plans are for the future of that business and whether there might be a future sale is going to be really important. And evaluation in these circumstances is going to be really important. So we would be recommending a formal evaluation would be taken of the business before any transfers are made into trust. It just means that then there's something to stand by whenever we're putting evaluation on the IHT forms and where we're claiming business property relief. So have an evaluation at this point would be really recommended. So those were all options that sort of like the more straightforward options, the typical options we'd be talking to most of our clients about. One other option I want to talk about today then, and Mark had briefly touched on it earlier, is the use of an employee ownership trust, which employee ownership trusts are becoming a little bit more popular at the moment, and think I had heard recently that there's something like 2,000 of these across the UK, but in Northern Ireland, I think we're quite far behind, and we only have something like 10 of them in place. So it is something that people are much more sort of becoming much more aware of and much more interested in. So really, an employee ownership trust enables a business owner to sell all or part of their business to a trust, which is essentially for the benefit of their employees. And the proceeds from the sale of those shares is free from capital gains tax. So the typical structure of an EOT is such that we would have an independent valuation carried out at the outset. So that establishes what the market value is, because everything happens at market value. The shareholders have to sell more than 50% of the business to the EOT. So this is sort of one of the conditions that has to be met, is that they're effectively giving up a controlling interest to the EOT. And that's typically for cash or a mixture of cash and an outstanding loan, which can be paid over time. So the cash consideration can be funded by external debt, so we can take on a bank loan, or we can use cash that's already sitting in the business to fund that. And then the EOT also uses the future profits of the trade to repay any future consideration that needs to be repaid to the sellers or to any lender via just a cash contribution from the company up to the EOT and then out to the seller or the lender. The typical growth profile of sellers is typically tends to be at the moment sort of such that growth has kind of slowed and is steady, and you maybe don't have a typical sort of market for the business. EOTs can be really, really useful in those circumstances. It does allow the business owners to step back at their own pace, because they can essentially still be involved in the business going forward. Where excess cash is built up in the business, an EOT can be useful because that cash can then be used to fund the purchase of the shares by the EOT. Where they have little debt and they're actually able to take on finance, that can be a good circumstances to use an EOT. Quite often they're used in circumstances where the business owner maybe wants to reward employees. So it can be used as a really good tool for rewarding and incentivizing employees going forward, because they feel like they have a stake in the business going forward. There are also tax-driven motivations for doing these as well, obviously with the capital gains tax-free disposal, and there's also the fact that the shares in the EOT going forward are not within the scope of IHT as well. So typically for sellers, as mentioned, more than 50% of the share capital has to be sold to the EOT, so they have to give up controlling interest, although they can still be involved in the business going forward. There's a sale at market value, and tax-free disposal is very attractive. There are flexible options around the deal structure, so that could be all cash, or it could be some cash up front and then the balance due to be repaid to the seller going into the future, and then that balance to be paid to them plus interest then can be repaid in the future just using the profits of the company. And it's a great way to realize value now and implement a succession plan, and it can really provide an exit route where there isn't a sort of a typical market for the business. For the business itself, it tends to be business as usual. It just that the business has a new majority shareholder, which is typically a professional trustee. The board and business leaders can remain responsible for the business and can continue to be involved in operations and strategy going forward, which can be very attractive for a seller. It can be self-funded and it can be affordable, so it's not necessary that the external debt has to come in and be used. As I mentioned before, it can be a real boost for recruitment and retention and incentivization of employees. And the shares in an EOT are outside the scope of inheritance tax. So you could actually use it to grow a business and scale a business in the long term in the UK, because the fact that they're outside of the scope of inheritance tax. And then there is flexibility in the future. So once the shares are in an EOT, there's still flexibility to pursue other strategies in the future, such as a sale, an MBO, or IPO. For the employees, they effectively feel like they have a share in the business, and they can share in the future profits of the business. And really, where an EOT is in place, it's really an opportunity that most other employees and other businesses don't tend to have. One of the conditions is that all employees have to benefit on a fair basis, so there won't be sort of one group of employees potentially benefiting over another. Employees can receive a tax-free bonus every year up to the value of £3,600. So that can be a really good little incentive for putting in place an EOT. Shares are held in trust for the benefit of the employees, and it can guarantee sort of some longer term certainty around the ownership of a business. So that's just something that we're seeing a little bit more of at the minute. I just wanted to share with you. You may be seeing that yourselves, and people may be sort of considering that as an option. So really, what are the key messages for today then? Starting conversations early, as Mark had mentioned earlier on. Appropriate planning does take time, and I'm very aware that we have almost a year until these plans will actually are supposed to be introduced. But again, the fact that we have a budget in the interim kind of does make us a little bit nervous. Understanding the short, medium, and long terms of objectives of our clients is really important. So understanding what it is that they want to get out of the business, what are their plans for the business, what are the plans for the family? Do they have, is the next generation coming along and going to be involved in the business? Or is there a plan just to sell up? So all of those things will impact how we advise people going into the future with these new rules. And then all business owners really just need to have a plan, and that plan probably needs to be socialized with the lawyers, the accountants, all other professional advisors, FDs, financial advisors. So it's going to be really important that business owners do have a plan, and that we don't just sort of bury our heads in the sand at this point in time. So that is it for me. I think I'm going to hand over to Gillian, who may be taking questions.
Thanks very much, Gemma and Mark. It was a great update. So I have a couple of questions here, folks, but if you've anything, we do have a few minutes. So if you've anything that you do want to raise, just pop the question into the Q&A box and we'll pick it up. But a question here, are there any signs that changes to BPR and APR might be reversed or revised?
Great question.
Or is that wishful thinking?
I think it may be wishful thinking. I've had lots of conversations with people recently, and that is one of the questions that that they commonly ask. Some people had sort of some views that the limit might be increased, so we might get away from a £1 million limit, and maybe we might have an increase in that threshold. Haven't seen anything recently to suggest that will happen. And then we do have some people really keeping their fingers crossed who are hoping for a complete reversal. I think if we're going to see any changes, we might have seen it in the spring statement. It wasn't mentioned at all. So we're just going on the basis that this is happening, and we have potentially until April, but definitely until October to do something about it.
Okay. And one other question in relation to pensions. Somebody's saying that they understand pensions may come into the scope of IHT, and is that something that business owners should be concerned about?
Yes, so that's another introduction in the budget, and it probably deserves its own webinar. So pensions are going to come into the scope of IHT, or due to come into the scope of IHT from April 27. So we have a little bit longer to plan for those, but it is something we're talking to business owners about at the moment, particularly where maybe we have business property or commercial property is sitting in a pension fund. We're trying to understand, what that means for them, and is that the most appropriate place perhaps for the property to be sitting at the moment. And we do have some individuals who have built up significant pension pots, and in the past it was sensible to hold on to that, and that would have been the last asset that you would have looked to do something with, or it would have been the last income that you would have expected to draw on. Whereas now we're starting to think about, should that be the other way around? Should we be looking at drawing on pensions much sooner, and particularly where we have properties like business properties sitting in a pension fund, is that really the most appropriate place for it? So we are waiting on obviously like all of the sort of the formal legislation and everything is due. We'll have to come out on this, but definitely something we're talking to people about at the moment. But we do have a little bit more time to plan for it.
Okay. Another one in here, based on evidence to date, are there any particular sectors or sizes of business which lend themselves better to EOS?
EOTs, not, I guess we're probably talking about is slightly larger businesses. We've really seen who have been going into into EOTs, maybe sort of like 10 million plus. That tends to be what I tend to see. Mark, I don't know if you're seeing much in the way of EOTs at the moment. Like I say, there's only about 10 of them in Northern Ireland
Yeah,
at the moment, so we're
I
kind
think
of
about
still in that
that
process.
10 million
Yeah.
level probably be about right. And we've seen it, I think there's been one or two professional services firms have done it as well. So quite often professional services, we've seen a few manufacturing ones, and quite often it's where if it's a really big regional business, there'll probably be some trade interest in it, which gives shareholders an opportunity or an option. But actually where it's perhaps more of a tied to the local community business, but with a sizable value, that's where the market can be quite challenging. And in those kind of businesses, you're looking at MBOs or employee ownership trusts. And again, a combination of that is probably where we see it going in the future. I think it also is very helpful for a family business where their legacy and their kind of place in the community is important to them. That might drive a decision to go down that route particularly.
Okay, thank you both. I don't have any further questions. We're almost at time. So Gemma, Mark, thanks very much indeed for your time and your insights. And I believe we will be sharing the decks with everybody on the call over the next day or so. So thank you all for joining, and have the rest of a good Monday. We'll see you all again soon. Thank you.